Hi, morning everyone. Welcome to the STANLIB webinar on looking at some of the risks and opportunities of investing in South Africa. Specifically, I guess, focused on the fixed interest area and on what's happening to some of our infrastructure investment and credit in general. During this webinar, we're going to be chatting to Victor, who's the head of our fixed interest franchise, and Johan, who heads up the credit alternatives franchise, to really explore what they've seen in their space and tackle what are some of the obstacles South Africa's facing now in terms of trying to move this economy forward. Before we get there, I'm going to spend about 15 minutes going through some of the updates that I think are important now from an economic perspective. I do think that the world economy is moving into much better shape. Some of the numbers are being ramped up very quickly. So I just want to put that in context and then talk about South Africa within that global context. And there are some positives coming through, and I've certainly become a bit more optimistic in the last few weeks. And I think if we can get the vaccine rollout gaining momentum, then I think confidence will start to improve. So quite a lot that we want to focus on. The way we're going to do it is, as I said, I'll talk for about 15 minutes. Then I'll chat to Victor around what he's seen in the fixed interest space for another 15 minutes. Then we'll talk to Johan in terms of what he's seen on the ground in terms of some of the fixed investment projects that are happening, some of the general investment initiatives that their team is involved in. And then we've set aside around about 10 or so minutes at the end for some questions. During the webinar, we're not going to be using the chat system. We're going to be using the Q&A. So if you go to the bottom, you'll see a Q&A that will be open throughout the webinar. And we'll certainly try and get to a lot of those questions as we go through them. What would be useful is when we're chatting to Johan and Victor, if you've got any specific questions around the fixed interest space or around investing generally, maybe put them on the question and answer there, and then I'll pose those questions during that part of the discussion. During my part, I'm going to be using a few charts, so it's going to be difficult for me to deal with questions at that point, but I'll try and revert to anything that comes up later on in the discussion. Please, as usual, if you want copies of any of the material that is available, or if you're looking for other stuff that you're struggling to get hold of, please give us a shot. It's entirely possible that we'll be able to help you. Okay, so I'm just going to put up my charts and we can get into the discussion. All right, there's a question immediately about how many CPD points. I'm not entirely sure at this stage, but hopefully we'll give you an update before the end of the webinar. So I'll come back to you with that. And as I said, Mark asked about the presentation. That certainly is available. Okay, right, so here's the main issue for me as far as South Africa's economy is concerned. The world is moving, the world's moving on in terms of the vaccine rollout. Not everywhere, but key parts of the world economy are making progress. And you would imagine that that progress will continue on and gain pace over the next, let's say, 6 months to a year. And there's no doubt that the world economy is going to enjoy above trend growth during the course of this year and probably during the course of next year. Now, there are two key factors or forces, that very powerful forces, that are going to ensure that most economies experience above trend growth for the next 2 years. Those two key forces is a base effect. The base effect here is enormous. You could see it with the Chinese GDP. Have a look at the first quarter estimate of China GDP that came out at 18% year on year. And that gives you some understanding of just how powerful the base effect is going to be. And China didn't have that severe of a decline as a result of the COVID effect. So that base effect already evident in a range of Chinese numbers. And you're going to see that base effect and more in a whole range of economic indicators. I'll give you another idea. If you look at South Africa's manufacturing, if our manufacturing production stays exactly where it is, month by month, there is absolutely no increase on a monthly basis. Then for the year as a whole, for this year as a whole, relative to last year, manufacturing will grow 12%. And there's no doubt that that will wash through to the overall GDP. Then most sectors are going to experience that base effect during the course of this year. And it's a very powerful thing. And even though analysts keep saying, oh, there's a base effect, the number's just gone up because of base effects, the headline number is going to look spectacular for some countries. And it's going to result in this feeling that the world economy is rebounding. The second powerful force, which I think only really manifests next year, is pent-up demand. And pent-up demand is a phenomenally powerful thing because it's across the entire population. Now, it's not in every sector, but you can imagine how much pent-up demand there is in the tourism sector, travel, entertainment, and I guess it's generally a whole range of activities that have been put on hold, sporting events, all of these things will come back and probably with extra exuberance. And so you're likely to have that effect wash through the data next year. Certainly for South Africa, it's not this year's story, it's next year's story. So those two powerful forces are going to result in the world economy and most economies enjoying above trend growth. What's more important than that, way more important than that, is how does the world deal with this further on? In other words, what about instead of the next 2 years, what about 3 years, 4 years, 5 years? And in South Africa's case, that is unbelievably critical because we want to be in a position where we're starting to generate sustainable growth that adds employment. If we find ourselves in year 3 and the growth rate slows back down to 1% or less, then clearly this country is going to be in enormous difficulty. And many of the valuations that we see in the markets today aren't going to be justified. So it's critical that we start to understand not just the base effect, not just the pent-up demand, but are there structural changes happening, particularly in South Africa, that will lead to much higher growth down the line? And that's what I want to start to explore today. And Victor and Johan are uniquely placed to discuss some of those aspects. So let me show you how well the world is responding. And overall, you would say this is surprised on the upside, right? If you look at the world estimate for GDP growth this year and next year, well above the long-term average. Generally, the world grows at 3.5% on average. So anything above that is considered good. Obviously, last year was a decline, so that establishes the low base. And this year, the estimates are around 6%. That's phenomenal growth. And then next year, critically, growth rates are just over 4.4% anticipated at the moment. And obviously, a lot of this growth that you've seen is being generated by China and the United States, and that's fine. Those are the two world's biggest economies, but systematically, other economies will start to add to that. So the expectation is that the world is bouncing back from this COVID thing probably a lot quicker than what people imagined just 6 months ago. The vaccine rollout, as I said, is gaining momentum and it's working. I mean, as much as the media focuses on blood clots and the exceptions, in total, when you look at Israel, when you look at parts of the US, when you look at the UK, countries that have made progress with the vaccine rollout, this thing's working. So I'm confident that the world will be able to engage more fully next year. It's also clear that we're going to end up with booster shots, right? All the major pharmaceutical companies are developing booster shots, and it's entirely feasible we'll end up with an annual vaccine that we have to receive, or just like you get the flu injection maybe once a year. you could end up with a booster shot for COVID. That's entirely feasible. In fact, it looks highly likely. But that doesn't stop the world responding. Now, there are a couple of things that have responded probably quicker than people realize. The one is global trade. Quietly in the background, global trade is up phenomenally. Yes, global trade declined in the first half of last year and went into a deep recession. But that bounce back in international trade has been spectacular, taking international trade already to a record high. Again, a lot of this is driven by China, but it doesn't matter. It's helping to boost the world economy. And as I say, right now, global trade at an all-time high. And linked to that, obviously, is industrial production, because when you're trading in something, physical goods. And so when you look at global manufacturing, it has also responded. And most people are not aware that global industrial production is at a record high, linked to a record high in international trade. And so the manufacturing sectors in the world have responded, again, driven to a large extent by China, to some extent, I guess, Germany, parts of the US, but there's been a spectacular turnaround, and that's very encouraging when you're South Africa, because South Africa is a very open economy. We trade a huge amount, both imports and exports, and so any vibrancy in world trade is considered to be an uplift for South Africa. Linked to that, therefore, is a bounce in commodity prices. And to me, that's understandable. When you get this much of a turnaround in international trade, this much of a turnaround in global industrial production, it's fairly natural off a low base that commodity prices will respond. And yes, some of this is purely driven by energy prices, but more and more, it's a broadening out of commodities. And we've seen the benefit of this in our exports. We've seen the benefit of this in our tax revenue, which we'll chat to Victor about a little bit later. But I think every time that the world goes through a commodity price boom, even if it's not a super cycle, I'm not saying this is a super cycle, but a commodity price boom, that uplifts South Africa. So it's a huge benefit. Linked to that is a massive fall off in trade uncertainty. So remember all of that anxiousness around Brexit, all of the concerns around the trade war between the United States and China when Trump was president. That's all dissipated. It hasn't gone away entirely. There's still issues. But when you measure the level of uncertainty people have, it's gone down to the long-term average. In other words, that extreme concern and therefore hesitancy about undertaking international trade is dissipated. And therefore there's no surprise that global trade has responded to the fall off in uncertainty. And all of that is helping enormously with this pickup in global GDP. And that would be a massive boost for South Africa as a stepping stone into higher economic growth over the next couple of years. So the reason why I'm flagging this is that it's a massive positive for South Africa. And then if you lastly look at global confidence, it's close to going to a record high. It's technically not there yet, but it's responded quite dramatically. And now, there are not many indices that look at confidence on a global scale. There are many countries that have their own consumer confidence or business confidence. But when you look at confidence in the world economy, it has responded dramatically, right? And so that's telling you that people are getting past or seeing past the COVID effect. Even though we're not past it technically, and many people are still dying and infected, the world is looking forward and can see the benefits of the vaccine and can see that the world economy is going to respond. And what we're asking ourselves is, how much of this is South Africa going to enjoy? And that's critical. And normally we would respond quite sharply to a pickup in world growth, but clearly there are a couple of domestic factors that are holding us back. And those are the factors that I want to chat about today. Now, in terms of our outlook for South Africa, I'm saying that over the next 2 years, we're going to enjoy above trend growth. Again, for exactly the same reasons I identified earlier. a base effect this year, which is very powerful, and then pent-up demand during the course of next year. Again, very powerful. And I do think that we will systematically make progress with the vaccine rollout. And let's say that in the first half of next year, we've reached a significant percentage of the population. At that point, I think the pent-up demand will become a real boost to this economy. So I'm fairly confident. What I'm not confident about is what do we do in year 3? What is that growth rate when we get further out? And are we going to be able to sustain that a lot higher? There are many parts of this economy that have already responded. I'll just quickly show you some of them. Obviously, our exports are doing much better. And if you look at the exports, I put these in dollars, but look at this chart going back on a monthly basis. Not great export performance. That's the problem with trade uncertainty, etc. But as soon as you get a pickup in trade, as soon as you get a commodity price boom, South Africa's exports respond, and there's no doubt that that helps us. And if we look at our exports specifically of precious metals, a significant increase, and that's washing through into mining company profits, and that's benefiting the government in terms of tax revenue. And yes, I don't think that we're going to keep going higher and higher with prices, but we've at least established a much more compelling base for many of the commodity prices. We've also had a reasonable recovery coming through in manufacturing. It's not spectacular. We certainly are fairly depressed overall, but at least we are getting back to the point where year on year the numbers are close to at least zero. Therefore, we're not having this perpetual decline. And as I say, the base effect is going to push this number significantly higher. And when we look at retail sales, those numbers are year on year positive. We had very good February retail sales, surprised enormously to the upside. And I think perhaps certainly the middle income to high income consumer, not as bad as affected as what many people assume. So there is some resilience in the domestic economy. Interest rates are going to remain low for a considerable time. Yes, inflation will move up because of the oil price effect, but I don't think it's enough of a move that will force the Reserve Bank to hike rates. So there are a couple of factors that will help us. What I'm worried about is how is South Africa going to deal with the outstanding issues? Now, what is that? The state of government finances, which I think is deteriorated very dramatically. We've got government debt at around 80% and clearly under pressure. And therefore, it brings into question what the credit rating agencies are going to do. And we're moving into that phase now. And that can have implications for further capital flows. And there's no doubt that linked to this is what happens to government salary increases. And can government stick to the idea that there are no salary increases for the next 3 years? And that's going to take a significant amount of political will. And to me, it's the first key test for government's commitment to trying to effect fiscal reform. And what I can say fairly confidently is that if we don't do these fiscal reforms, then the growth rates further out in year 3 and 4 are going to become very challenging. So it's critical that we get these done now. And then linked to that is a lack of fixed investment by SOEs and the shocking state of our state-owned enterprises and their inability to drive infrastructure. But in the business day today, I was reading about Durban Harbour and their container port saying they're going to embrace the private sector more. And we'll chat to Johan about what he's seen in terms of fixed investment. And again, if government is willing to embrace the private sector more and more in these initiatives, then I think we have a real chance of being able to lift fixed investment a bit and get some of this infrastructure done off an incredibly low base. But again, if government sticks to this idea that they are at the center and they are controlling all investment activity in this country that is of an infrastructure nature, then clearly year 3 and 4, we're just not going to get the growth. So to me, these are critical factors. Linked to that is the shocking state of municipal finances. On the chart, I've got 2 factors that are worrying me. One is outstanding receipts. In other words, how much money have municipalities not been able to collect? That is the bluish line. And you can see that number has ramped up to well over 220 billion. That's on the left-hand scale. So Last year was another problem in terms of residents not willing to pay municipal services. And obviously, you're getting more service delivery protests. And with the municipalities collecting less money, they're less able to fulfill the service commitments, and therefore more anxiety going into municipalities. And equally, municipalities are not able to pass over the payments to suppliers. So municipalities are not paying for many of the services they receive. And so it's creating a point of friction, and you can see it spilling over into social protest. So there are a number of these issues that to me are absolutely critical, that we've got to find a way to deal with them if we want to enjoy better growth further out. I'm not saying over the next 2 years. I think over the next 2 years, the base effect and the pent-up demand will ensure decent growth. What happens in year 3 and year 4? And if we don't start to deal with these issues now, then year 3 and year 4 are going to be quite problematic. So that's the element we're going to focus on. In order to do that, I'm going to chat to Victor, who heads up our fixed interest franchise, and just chat through some of these issues, some of these constraints, how he's seen them, and more importantly, I guess, how's he investing given these risks, and what opportunities does he see there? So Victor, over to you, maybe some introductory remarks, and then we can have a chat around some of the key issues. Thanks.
Yes, thank you very much, Kevin. Also, thank you for the wonderful charts. I think maybe the best place to start, given that you've talked about some constraints, that have actually made South Africa struggle, to develop and get the economy growing. One of those constraints is really the management of the debt trajectory, of the country. And perhaps maybe also, the best place to start would be to highlight the evolution of that debt to GDP trajectory. And if you go back to pre-global financial crisis, South Africa's debt to GDP used to sit at 27%. And where we're sitting currently, with the latest forecast from the minister, that debt to GDP is going to increase to just under 90%. And you will remember when we had the COVID situation last year, a lot of people started to talk about South Africa certainly heading for default or a debt trap. And if you head there, like we know with countries like Argentina and other countries, they've struggled to manage their debt trajectory. It leads to economic collapse, weakened currencies, and then you get downgraded and you struggle to come back to investment grade again. So debt in itself, Kevin, is not necessarily a bad thing. What is bad is what you do with the money that you get. So South Africa, when we increased our debt to GDP, we basically used the money to boost the public sector, employment, for example. Also, increasing the wage bill for the country. So that is not sustainable. We didn't spend the money in boosting the private, the investment side, where even businesses could invest and help to grow the economy. And then it put in enormous pressure, on taxes that we're supposed to collect. And as a result, we end up where we are. And in order to arrest this, I think Tito and the National Treasury, he does get it. For the first time since the global financial crisis, we are in a situation where we've got a minister that's able to implement an austerity budget, which now also, for the first time in a long time, we also, looking to reduce, the debt supply. So markets, reacted to all of that constrictions that were coming through as a result of our mismanagement of the economy and the mismanagement of the debt trajectory. And we saw, a huge premium, being placed on the yield curve, which weakened substantially. And then we saw, our yields, which at one stage just after the global, financial crisis, had touched 6.5%. We've seen these yields basically, staying elevated for longer, meaning that the borrowing cost for the country remained higher, and which puts pressure, on the debt servicing cost, which if it increases, then, the country ends up, paying wages, paying the interest bill, and less money basically going to the economy. So that presented huge challenges, so when the pandemic happened last year, markets were fairly justified, to react the way that they did. And we saw, a huge liquidity squeeze and foreigners basically exiting because they didn't have a clear line of sight, of where we're heading. So we are where we are now. Markets have discounted, most of the bad news, like you're saying. And there are some green shoots, that are starting to emerge. And we've been arguing that even though there is justification for the skepticism, there are opportunities that markets do present. Last year, in February, we had debt supply being reduced. We talked about the austerity budget, potential, some revenue coming through, but we never really lived to see the benefit of that because the global markets, which sometimes present opportunities and other times it can present threats. So US Treasury yields, rising, which was expected in discounting for inflation. But I think what the market struggled with was the pace with which that increase was coming through, and then it created its own volatility and had an impact in short-term bond returns. But we've been, on record, saying that we don't think that's going to be something that just continues to weaken. There's going to be opportunities that the market is presenting. We didn't feel the markets were. We felt that the US Fed, was quite slow in owning the narrative, which they have come through to do and try to get ahead of the markets. And as a result, even though US economic data is rising, inflation expectations have risen the way that they did. Last week, you would have seen US, yields starting to decline despite some of the economic numbers, coming through. And that's because there is still a lot of liquidity, that sits in the system. And that liquidity comes in the form of the fiscal, which is, for example, the 1.9 trillion that Biden talked about. It also comes in the form of the Fed leaving, or the central banks globally, leaving some liquidity in the system. And additionally, Treasury, through their management of their accounts, has actually been pumping some of that liquidity. And that's quite supportive for emerging markets, particularly when the dust, internationally has settled. And as a result, I'm quite constructive. We're quite constructive on emerging markets. And we think a country like South Africa would also benefit, like you alluded to, because there are green shoots. You look at our terms of trade, they have improved. Hence, we're not surprised to where the currency is. So I'm going to leave it there, just so that maybe I can allow you an opportunity to ask questions, around other things, including valuations.
Thanks, Vic. So let's get into some of the specific, and I've got quite a few questions that have come up. I'll weave them in as we go along. And just so to alert you, there's a lot of questions about the ABSA money market fund. So we're going to deal with that a bit later. But before I get into that, Vic, we've seen government reduced the borrowing requirement during the course of this year, right? Yep. And last year, effectively, government borrowed more money than they needed. And yes, that I thought was a very advantageous move. It was brave. Yep. They did it well. And I think they put themselves in a very powerful position. So yes, that this year they've reduced the borrowing on a weekly basis. And in addition to that, government has been able to announce that tax revenue has gone up further. And we've yep, seen the buoyancy from the commodity side into the mining companies, etc. Yes. How much confidence does that element give you with regards to the government's ability to get finances in better shape? Are those significant developments from your perspective?
Those are significant developments, Kevin. And I'll tell you, I know you're talking about revenue, or you could call it maybe the windfall that comes from commodity prices, where they collected an additional 100 billion rand. Last month, there was also an announcement of additional tax revenue, that's coming through. But what makes me comfortable is that the expenditure side of government, they are also serious, around adhering to the ceiling. And even in a year where we have local elections, they are willing to beg themselves that they're going to negotiate hard, on wages, and that they are going to also save on expenditure, wasteful expenditure, and they're doing that while receiving a massive revenues, that you'll get. And you would know that if they wanted to be populist, they could have taken the 100 billion rand or even the additional 40 billion rand and basically give it in wages, because it's an election year and governments, are mostly known, to do that. Yet, even though Tito doesn't want to consider that this is an austerity budget, yet they are actually taking that money to go and repay the debt. And maybe just also, letting on what you said earlier on, they were quite smart, last year by over-collecting, by building, a huge cash reserve, which actually allows them to go and repay, some of the debt and reduce the supply, into the economy. Because, certainly, we can't allow our debt servicing costs to continue to rise, because then it takes you even longer, to get the primary into a surplus. And that if you can't get the primary budget into a surplus, you cannot have debt sustainability. So that's quite positive for me.
Rick, we've got a question around bond auctions. Are the auctions being fully subscribed? What's the take-up like at the moment? And are we seeing foreigners in our market?
So the take-up on auctions, there's actually been good on average. Also, as a result of some of the actions, that I've talked about, like including wages, including some revenues that are coming through. However, the last quarter, there has been some challenges, and those were, as a result of U.S. Treasury yields, rising and continuing to rise, and as a result, foreigners basically exiting our markets at a time when there wasn't a natural bid, coming through. So that created a bit of liquidity challenge. But for one or two of the auctions where we cleared, I think in one of the auctions we cleared between 10 and 15 basis points higher than where the markets were trading. But that has actually gone away with all this liquidity that everybody is talking about globally, and also, the improvements the green shoots that we're talking about, earlier on. We are, starting to see auctions basically, clearing at better levels.
Victor, we're going into a phase now where the credit rating agencies will start to review South Africa. And obviously, Moody's has us on a negative outlook. Fitch has us on a negative outlook. Do you think they'll give us more time to see whether we can get the salary increases contained? Or are you concerned that they will lower the credit rating now?
So I think, if I were them, I know I'm not them, but I'm saying if I were them, I would wait to see whether the government can be able to deliver this. The only challenge, of course, is that the government has made promises in the past, their own promises, which they lived to break, So, but given some of the positive noises, that are coming from from National Treasury, I think it would be prudent, for them to wait and see whether this can be done, especially given that there was a court case which nobody expected, the government to win in December, which they did. It's going to go to the Constitutional Court, but nevertheless, it bolsters the government when they go for negotiation. And I haven't heard any noise. I mean, that the intention is to basically walk away from that. You know, so yeah, rating agencies, I think they could wait. But also, I mean, if they don't wait and downgrade, say, South Africa, you know, given that there's a negative outlook and all of that, also do remember that the impact of the downgrade now, especially if you're staying within the same bracket, you know, for let's say maybe you're staying within the same bracket of WB and you're not really moving to the next level. The impact of that is not going to be the same as when you are getting downgraded from investment grade to sub-investment grade, because that takes away the natural portfolio flows. I mean, that were stable. You know, we are already in junk status. Most of the investors that are coming in, they invest because they are seeing opportunities. You know, so the impact of the next move might not necessarily be that big, but where it can become big is if we get downgraded further down quite quickly, because what that means is that it will take us even much longer, you know, to get back to investment grade.
Rick, can we chat about the contingent liabilities that government is facing? Obviously, over the last few years, they've gone up dramatically as government has had to support most of the state-owned enterprises. But you get a sense that we're getting to a critical point here where government has to make some big decisions, right, around things like Eskom and whether or not Eskom is restructured and there's more private sector involvement, whether government is willing to support South African Airways. We can see that the SABC has had to retrench some people in order to try to get their finances better. How concerned are you that government is going to have to provide an ongoing life support to the state-owned enterprises that ultimately undermines all of the good that Tito's trying to do in terms of controlling the salary costs?
So that's the big challenge, Kevin, especially when you look, say, at rating agencies like Moody's, because I mean, when they look at South Africa compared to how they did, I mean, previously, they add the contingent liabilities that you're talking about on top of the government debt, which is why when Tito says debt to GDP gets to 89, Moody's says it's going to get to 100%, because the assumption is that the government is going to be responsible to sort out, I mean, some of that debt, and that's the biggest challenge that we've got. But from the information, I mean, that we get, the long-term project, I mean, for the government is basically to make most of these SOEs to be able to operate on their own and not just be dependent on government for funding, because I mean the fiscus cannot afford that. I mean, which is why you're seeing some activities, for example, around Eskom. I know, I mean, the land bank has become a mess, you know. But generally, I mean, my view is that government would want to see this sorted out, because if it doesn't, it can actually lead to the collapse, I mean, of the entire economy. So there are some SOEs that are quite big, and the president, I mean, has come out, or including Tito, you know, to say these are too big to fail and they need to be sorted out. But investors, I think, are looking for much more than that. And if we don't get on top of that situation, it can actually be the tailspin, you know, that nobody wants, you know, in future.
Vic, I've got so many questions on the ABSA money market fund. Can you comment on why did they close the fund, and what does that mean in our environment? And I guess people would be wondering from there, what went wrong? I don't know if you can comment on that. And are other money market funds at risk?
So I think I'm going to stay, of course, I mean, with the prescript, you know, that I mean, the ABSA, for example, gave. I mean, one of the reasons was that they felt investors, you know, when they are investing in the ABSA money market fund, they think that they are actually, I mean, their investment, you know, is going to is guaranteed by the bank or the bank's balance sheet, you know. And I mean, for them, obviously, it presents huge risks. I mean, you can imagine if you have an event, you had an event like what do you call it? I mean, African Bank. Now you having an event like the Land Bank, and you don't know whether there's going to be another credit event down the line. You know, it can actually put a huge pressure on the balance sheet of the bank. So for them, I think it's a way of clarifying the difference between a collective investment, where the investments are done on an agency basis, and the balance sheet where you go directly, I mean, to the bank. So yeah, it has led to maybe some investors that might have interpreted it that way, having to readjust their investment destinations. I mean, on our side, I mean, we've seen some flows, I mean, also coming through, you know. So, but I think for investors, there are enough investment destinations, I mean, that they can look to. But what is important, I mean, including any investment that they do on a collective investment basis, is that investors, I mean, should understand that once you're coming into that space, they should put their full faith on the investments that sit inside that vehicle and nothing else. I mean, outside of that, you know. I think. Yeah. On our side, I mean, for quite a long time, we've been also, I mean, at pain, you know, to explain, I mean, that migration, you know, to say, yes, you're coming into this portfolio, you're buying into the management expertise, I mean, of the team that is doing that, and there is nobody that guarantees this over and above that. You know? So yeah, if I can leave it there, Kevin, because obviously.
Okay, I mean, that's great, Vic. Last question, if you can be quite brief, because I'm worried about time, and that is,
yes,
what is when you look at the yield curve, how are you positioned relative to the yield curve? Where do you think there is value in the bond market, income fund, that range of products? What's your thinking around positioning at the moment?
So even though you've asked about the yield curve and you said I must be brief, I'm going to be brief. I think what I want to leave, you know, for our investors is that we've been constructive on bonds in general. I mean, we see fair value at 8.5 on SA 10-year bond yields on an outright basis. We are constructive on the yield curve, so we've got more longer dated bonds than shorter dated bonds. And I think, I mean, some of the benefits of the positive capital valuation are coming through because of the better management of supply between inflation-linked bonds and nominal bonds. Inflation-linked bonds did well last quarter, but we feel that nominal bonds will continue to do better than inflation-linked bonds through the cycle. And on credit, we like credit now, I mean, given that it had corrected, but we believe, I mean, we should be selective, you know, in choosing the different sectors on that. So in general, we are constructive, I mean, on the bond market, and our view is that you should run a little bit of duration, I mean, on the portfolios.
Okay, thanks a lot, Vic. We'll come back to you right at the end if there are a couple of questions. So I want to turn to Johan from our Credit Alternatives franchise. Johan, obviously you're involved in a lot of what we would call the real economy. In other words, understanding some of what's happening in infrastructure, some of the investment initiatives out there, and obviously you try and participate in that. So can you just, for a couple of minutes, give us your take on where we're at in terms of some of those projects that are materializing or not materializing?
Yeah, thank you, Kevin. So I think importantly, kind of listening to yourself and Vic talking and looking at some of the graphs that you put up earlier, I think just philosophically for us, we don't view the role of the state or SOEs necessarily as being critical providers of capital into the real economy, as you state. For us, the role of the state and SOEs should much rather be to facilitate investment into the country as opposed to being kind of funders of last resort, right? So that's balance sheet of the state that is looking precarious is not something necessarily that the private sector is looking to for capital flows. And I do think in stating the role of the state as being a facilitator of capital flowing into the country, it's kind of an obvious statement on many different levels. But at some point during the conversation, we do need to get to PPPs, which obviously we are a big promoter of on behalf of our clients, and often look at some of the opportunities brought about by the various PPPs that the state, where the state does play a very critical role. Ironically, I think it's worthwhile just briefly stating that often it is in the failings of the state and SOEs in South Africa that we see opportunities for the private sector. Right, so you mentioned earlier the Trans-Eva is looking to open the Durban Harbour for private players in its container hold. That is because its balance sheet is being constrained through, all the factors that we've mentioned earlier. Some are positive, but a lot of negative reasons why they're doing this, i.e. there's an opportunity for the private sector to enter what has typically been the prevail of the state. Other examples are within agriculture. We all know that the land bank is finding itself in trouble. And in fact, we are seeing that many private players are coming to us for longer term capital to take on the role that the land bank had played in the past. So again, a double-edged sword, the energy supply issues in the country we don't even have to refer to, but the private sector is chomping at the bit to start playing in the space where Eskom in the past have played and where they're still occupying a very critical place. I think it's important to quickly mention that South Africa does have a lot of systemic inhibitors to growth. Both physical and intellectual capital is in shortage, and this shortage means that for as long as we remain underinvested in the country, we will struggle to have longer-term high growth rates like you may find in other places in the world. That said, for a capital poor country, to the extent that people are willing to invest, they do sometimes see very attractive and interesting assets, attractive returns and interesting assets. Some of the ones that are coming our way, and by the way, we are seeing green shoots, we are definitely seeing an uptick in demand for capital. The type of capital that we supply is obviously credit capital. It is longer term, fairly patient capital that suits our longer term clients. These are pension funds or life companies. And the areas where we're seeing quite a lot of activity, in fact, this year is quite a big year for public infrastructure. So renewable energy deals are being refinanced. There's the risk mitigation transactions that have been announced last year that are being funded this year also. We're seeing quite a lot happening. So apart from that public infrastructure, we're seeing quite a lot happening in housing, assets, telecoms, healthcare, etc. I mean, there's quite a long list. I'm not going to ramble down, but just to say that there is quite a bit happening. And the important point, and I think why it's relevant for our audience today, is that these investments, as they start coming through, as the private sector steps in in a sense, make the most to start mining some of the growth in the short term. These are capacity building investments, capacity building opportunities, longer term, so it could address some of the constraints in the economy. And that's also why we are really interested to support some of the borrowing partners that come our way to match them up with the longer term capital that we manage. I think in closing, just important to mention that there are obviously risks. Yes, the state finances are a big risk. Obviously, there's the political economy. So where the governing party wants to take the country remains a risky thing, even though I think we all must acknowledge that we're in a better place than where we were 4 or 5 years ago. And then I just want to acknowledge also that we may be facing more in the shorter term, a third wave, maybe even a fourth wave, as we wait for the rollout of vaccines in South Africa. It looks like a small risk at the moment, but it's one to keep an eye on. So in the shorter, medium term, you do want to support assets and projects that could withstand shorter term shocks and can be robust to withstand some of those downside risks. Yeah.
Thanks, Johan. So would it be fair to say that there's more positive activity now that you've seen than there was 2-3 years ago? Has the process moved along convincingly enough to be more encouraged?
Yeah, absolutely, Kevin, absolutely. Sometimes it's interesting, you talk about pent-up demand, but I also think there is sometimes a bit of pent-up confidence that investors are looking for something to happen that clears the way for them to start kind of redeploying. And I think with what had happened last year, in combination with some fresher winds, policy winds, blowing through the corridors of the state, as well as I think a greater acknowledgement for the need to attract capital and facilitate capital investment into the country. I think we're seeing the real economy stepping up to a degree. We are absolutely seeing more demand than what we have seen for 2-3 years. And I think those factors are some of them. Also, your pent-up demand points, these all are playing into the bigger pipeline that we are seeing coming our way, and broadly speaking in the market.
Johan, what is your sense of the attitude of government towards private-public partnerships? Now, we've seen government talk about PPPs more actively. We've seen a couple starting to come about. Do you have a sense from government that this is still a reluctance and they're doing it only out of absolute necessity? Or is there any recognition from government that this is ultimately a win-win? It's beneficial for all parties. Has that ideology changed?
Yeah, so Kevin, I must be so careful, obviously, in answering that question, because as you know, government has many different voices and many different faces, and sometimes both different ones rear themselves at the very same point. So let me point to some of the very tangible examples of what has happened in the last 12 months. So the first is that obviously there's a so-called risk mitigation independent power producer process that has been kicked off. It's quite a large further energy procurement process that was, in fact, it was started last year and it was awarded during the course of last year. So this is obviously under the Department of Energy, but then also the Minister of Public Works, which is Patricia de Lille, launched what they call a strategic integrated project, strategic integrated infrastructure projects, which had quite a bit of airtime during the course of last year. And this is a number of projects that they had identified through the Department of Public Works and actually had gone and gazetted across different sectors: housing, water, sanitation, transport. Again, energy features quite big, and they are looking for investment from the private sector into these, right? So look, a lot of it is pretty ambitious, can I say the word, i.e. whether or not they will find fruition, the jury is still out. Often for the private sector to be able to participate in public assets or public infrastructure, you need regulation. Sometimes that regulation is slow in the making and it fizzles out in time. But having said that, the mere fact that these were gazetted, the private markets are being engaged on them, for me says that there is a true kind of drive to attract capital, private capital, into this capacity build and expansion of infrastructure. Now, you know, they say necessity is the grandfather of invention. Possibly that necessity is also the grandfather of changing your mind philosophically about the place of private capital in the broader state apparatus. It is clear that it is necessary to partner up with the private sector in order to get infrastructure build going. There is no way government can do it on their own. Interestingly, in speaking to the minister, she acknowledges that their lack of capacity is not only financial, it is also intellectual, i.e. a lot of people have left the private sector that had the skills to onboard some of the projects that they have shortlisted. And as part of them reaching out to the private markets, they've actually come and said to us, would you have people to spare to come and help sit on a temporary basis in our offices to kind of onboard these projects and give life to it? Now politicians, the way that they put these things, they often talk about us being one big family, happy family, which is obviously not the language that finds its way into the public sphere. But I think there is a kind of a broader acknowledgement that simply says, guys, if you want to get this economy to start growing properly beyond that 2-year point that you highlighted, we have to work together with the private sector. We need to drop the animosity and we need to get people literally into the room to help us make things work. So it's been an interesting 12 months from that perspective.
Johan, can you briefly just chat about the importance of the spectrum auction? As far as I know, this thing is still in the court system, and I don't know enough about that process, but why is it such a critical thing to go ahead?
So, Kevin, I'm not gonna go too much into the court process and some of the wrangling happening there. It's obviously between Telkom and ICASA, and also between MTN. Vodacom has been silent on the side, but the point is there is a protracted court process that has halted the spectrum auction. The numbers themselves are not that big, right? So they talk about in the order of 8 billion rand or 500 and something million dollars. So that's not the thing that's important. What really is important is the downstream outcome of the spectrum auction, should it have been awarded, is the fact that broadly speaking, within the country, we are expecting to see lower data costs, obviously a greater access to data through the bigger spectrum, greater speed of data, and greater efficiency, broadly speaking, within that spectrum. And all we need to do is look at our behavior this morning, the importance of access to data, the importance of efficient access to data and lowering the cost. We've got an outsized, unnaturally high costs of data in South Africa, and to broaden access in the 21st century to data is critically important for a developing economy, and people out there that still remain excluded from critical parts of what the 21st century economy looks like. So really important that it goes ahead sooner rather than later and increases access to data for everyone in the country.
Johan, I'm conscious of time, so I just want to ask you a final question, and obviously a difficult one. What would be your best guess on when we would start to see some of the fruits of this activity and discussion and PPPs? When do you think it starts to show up in cranes, in a bit of employment, in slightly better growth, when do we start to see it, visibly see this stuff? Because when you see this stuff happening, it makes a difference to your psychology. You start to believe that the economy is moving forward. From your perspective, when do we think we might start to recognize that there's a better investment environment unfolding?
Yeah, I'm going to answer it in two ways quickly, Kevin, which is again to say the private sector has been and is already investing in South Africa. It's not at the levels where it should be, but it is. And traditionally, the private sector's investment is plus minus 2/3 of the overall component, with government providing the other third, right? So all you need to really do is drive to the northern suburbs of Johannesburg, or even the northern suburbs of Cape Town, some of the northern suburbs in Durban, to see some of the investment that is going on, and remind yourself that this is real investment into the economy, launched by the private sector for its own benefits, and show some confidence in the economy, and feel better, and have an espresso at one of one of the new shops and shopping centers there. When it comes to PPPs, this is longer in the making. You're going to see the energy space, which is more able to deal sooner, take off. But certainly, so there I'm talking immediately in this year, some of those projects will be awarded in the energy space. And so this year and the next 3 years are critical to build capacity in the energy space. The other projects are more complicated and will take longer, 3 to 5 years. And please, whomever we pray to, that they do succeed and it does take off.
Okay, so I think we've come to more or less the end. I've got a couple of quick questions if people are willing to stay on in terms of the time. I'm very conscious of time. Victor, just a quick question for you. Obviously, we've got the local government elections. How big a factor do you think that is in terms of government, from a government perspective, government finance, and the ability from government to manage their fiscal position? Is it something you're worried about?
No, I'm not too worried about it, about that, Kevin. Especially from a market point of view, I would be worried if government was showing intent on taking a populist route, to try and win elections, and that doesn't seem to be what is coming through. I mean, if they were to go populist, then yes, it was going to put some pressure on the finances of the government. Then basically, I mean, reverse whatever I've said about the green shoots that we see.
Okay, we've got a question that I'll deal with around the currency. Obviously, the currency's been quite strong. There are a couple of reasons for that. The one is that there is a bit more interest from foreigners in emerging markets broadly, including South Africa, so that helps. The second is that our trade balance has been good, and so that generally helps. And then I guess the third factor that gets missed all the time is that the dollar itself has been under a bit of pressure. In terms of the currency outlook, though, we keep making the point that with commodity prices as strong as they are, it's very difficult for the rand to weaken. In general, there's a good relationship that when you have a buoyancy in global trade, a buoyancy in commodity prices, the currency tends to be able to hold on. Now, that won't last indefinitely. Obviously, at some point, the commodity price cycle will start to roll over, even on a year-on-year basis, in which point we think the currency will come under pressure again. But in the short term, 3 to 6 months, I think the currency can hold on to these levels. And when you look at fair value, the currency is now not that far away from fair value. In fact, some of the fair value models suggest the currency is already at fair value. Johan, I'm hoping you're still around in terms of being able to take 1 or 2 questions. In terms of the municipal finances, is it a concern, or is it something that it's in the background at the moment and you're watching it quite carefully?
Yeah, Kevin, I don't want to diminish some of the credit concerns around the public sector. I think it is obviously a concern. It is in no one's best interest to have some of these munis struggle to meet their obligations, because it's got a downstream. Your graph was very interesting. You showed 76 billion rand of outstanding payments, typically to private sector players, right?
Yeah.
And to the extent that there is this kind of bottleneck and an inability to service, it ripples through the economy. And what we are hoping for is that you can unblock the bottleneck through PPPs and get the economy to start functioning again. But those are concerns, absolutely, and obviously always top of mind when we assess opportunities, how that bottleneck may cause damaging ripple effects.
Johan, there's also a question around how do retail investors start to access PPP projects, infrastructure? It's obviously quite difficult, and there are indirect accesses through other investments. But at this stage, it is, I'm right in saying that this is more an institutional type investment, or is that changing?
It is an institutional type investment at the moment. I do want to say, before I give an answer of when they can start accessing, let me quickly say why we thought this is an interesting topic to have in front of the audience this morning, is because it speaks to longer term growth. So be clear, to the extent that we are seeing these green shoots, ultimately it will feed into growth in the economy with the more traditional asset classes benefiting from that. Then the last point I wanted to say is please watch the space. Vic and I are working together to try and get some of this product in the hands of the audience listening to us today.
Okay, I think we've come to the end. I haven't dealt with all of the questions, but I'm very conscious of time. Thanks a lot. Thanks, Victor. Thanks, Johan. Thanks for your time. Thanks for your insights. If you're watching, please, as I said, there are some questions around charts available. That's all available. And if you've got other specific questions, we'll try and deal with them. But from my side, thanks for joining in. Thanks for taking the time. There are lots of webinars out there. So I know it's a competitive landscape. And if you've got, importantly, if you've got topics or questions that you want us to deal with in the future, why don't you just pop me an email? We're always looking for what clients want to hear about, and we can certainly try and tailor the discussions around that. But from my side, thanks a lot, guys. And we'll chat soon. Thanks, Vic. Thanks, Johan.
Thank you for hosting.
Thanks, guys. Bye-bye.